Happy weekend, everybody. This is today's silver log. And before we get started with the technicals, I want to do a quick little update on the blog page. The link is in the more information box. It is the silverlog.blogspot.com. And on this log, what I've been doing is embedding some videos. If I find anything good within silver, whether it's by a video or an article, I want to put it within this page. And I made this video yesterday comparing a silver dollar versus a paper dollar. I've been putting some charts on here. Yesterday I put this chart on the blog, which is SLV, the ETF for silver. And I was mentioning that within these biggest lows over the last month or so, and its biggest highs, that it has managed to come down to its 2/3 or 61.8% Fibonacci level at SLV 1753. Looking down, we can see how it managed to find support at that 1753, or at least thus far it has found support there. Whether it will hold, that will be another question. For you come down there, you find that area of support. The more time support is tested, the more often it can be taken out. This is its second test of this Fibonacci level. And I've been putting a lot of articles on here, the ones that I posted on Friday. The case for investing in silver. Is silver set to move higher? Silver, the forgotten metal. Investors Chronicle. Why the really big play is in silver. Predictions, silver will go to parity with gold. And on the Thursday blog, I was showing this VWAP level, which was, I think, a very important level. It obviously managed to go through this particular level. And Stella Concepts did a Quicksilver update that's been embedded in the page. And the articles on Thursday was Silver 2 of 7, investing in silver coins, silver futures, and silver stocks. Silver Wheaton's call options move up today. The article on that, this is a silver Wheaton chart. And if you want to look at any historical stuff, there's a blog archive. So you can see on August the 13th, it was, I don't even remember what it was on this day. A few FinViz charts talking about some Fibonacci numbers that would be on the screen. I also put a little poll on the screen. Silver is currently in a range. Which direction do you think it will break out of in 2010? Upside area to the 21 area. Basically, small upside move, major upside move, small downside, big downside, or will not break. 11 people, including myself, felt it was going to go to the upside area of 21. 7 thinking big highs, and 1 person thinking a small gain, 1 person thinking a small loss, 1 person thinking a big loss, and 1 person thinking it will not break out of the range. So now what we're going to do is we're going to start with the technical analysis. There will be a new poll next week on the screen. That poll closes at midnight on Sunday. So we got this daily chart with silver, a lot of moving averages within this chart, and this pretty much primarily traded within an upward range in 2009. And if you, I've been showing you the 40-year chart on silver, a major upward trend. And a lot of it is because of the fiat currency. When you adjust these for inflation, it's nowhere near in this trend. If anything, it's trying to break out of the bottom part of the trend, as a lot of the silver price has been manipulated, and a lot of the articles that I talk about will have stuff including that within it. And these averages on the screen, you have the 50-day moving average, which starts here. There's a 200-day moving average somewhere on the screen. I think it's the red line. It's not the red line. But a lot of these are running averages from different totals. The moving averages in this particular video doesn't really mean too much. The whole point of this is to state that because we've included weighted averages from the start of each one of these quarters so far, that a lot of them are below the price, which is showing us that we've been in mainly a time consolidation. Markets can correct either through price or through time, and we are seeing a market correction through time. Now, if we go through the stage 1 to stage 4, there are 4 stages the way stocks trade at. So when you have a situation where stocks are going sideways, and then all of a sudden you start to see how stocks start to go higher. You're now in a stage 2, as they say, a stage 2 uptrend. And then when it starts to just neutralize like this, you can call it a stage 3. And the stage 4 would be the move lower. So this here is a stage 2. So either what this is going to be, this is either going to be a time correction within the stage 2, or it's going to be the stage 3. A lot of it will depend on which side of the range that it happens to break out from. What we're going to do now is take a look at the same chart, but only look at a few periods, and then eliminate all of this other clutter in here. And this is the chart. And the range, at least what I'm seeing here, is the biggest part of this range is between 1750 and 1850. That's where the majority of the range has been. We had a breakout on 2 different occasions that did not manage to hold. And in fact, the breakdown on each one of them created a fast move to the bottom part of this range. You can also make a case that, well, that's one of the ranges, but obviously this is a longer standing range that not only lasts for the last year, but it actually goes back to the 2008 spring highs, or the spring range also. And therefore, the majority of this range has been traded within the downside of it. So most of it has been showing us that it's been lower. That doesn't mean it's going to break out lower. It just means that that's currently, or where it has been trading for the majority of the time. Question is, how can we tell when the range is broken? Obviously, you can see, well, maybe we come down and break below the range, find, I'll just do a little example here. Say we break below, and then we come back, find resistance. That's an easy way itself. But what I'm going to do in this video later on is talk a little bit about volatility, which may help out to determine when the range is really going to break out. The next chart that we're going to take a look at indicates its 50-day high and low. This is something I thought would be a pretty cool idea, and it's worked out fairly well, actually. What it does is it takes what its current, or at the time, what its 50-day high and low happens to be, or 50 period. And for example, on this time frame here, we can see that the 50-week low was based on this February low, and the 50-week high was based on this high. So therefore, what does this mean? Well, I can make some nice technical indicators from this, which I will do in a little bit. But what I want to point out is how the lows are getting higher and the highs are getting lower, which means we are really getting crushed within a tighter range. So therefore, what I'm going to do now is I'm going to take a look at its next chart. This is an indicator chart. This tells us where we are from the 50-day low. So right now we are about, and this is updated as of, I think, Thursday's close, which means we were actually down here. We're about 5% above from our 50-day low. And generally what I've been noticing with this chart is a successful, or what has been very successful, is going long on a breakout of this, or whatever, the breakout of a reversal. We can see here we made this higher high, we made this higher low. So a breakout here would be a successful trade. On the second one, we made this high, we made a higher low. So therefore, the breakout in towards here, the second breakout of this high, would be a successful trade. The last one, we had this low in here, we established this high, and the breakout of this high was its previous trade. So therefore, if we take a look at this on a spreadsheet, the first one going long on May the 1st at 12:27, let me just move this chart. Going long on May the 1st, 12:27, that was this here. And the caution is right down here. There's a caution in here, and then a caution breakdown towards here, caution in here. It takes a lot of understanding the charts to be able to do it. However, on the first one, it was saying to go long at 12.27, was giving caution in June of '09 at 14.86. July 31st to go long at 13.92, which was this area right in here. And it's said to get out at 16.46 on November the 2nd. Then on March the 1st, it's said to get back in at 16.45, and then it's said to get out at 18.12. So now the question is, when would you get back in if you were to use this type of system? The answer is a breakout of this particular range, because we've already developed a higher low. We've developed this higher low in here. Now what we need to do is got to get above this resistance. And what I've done is I've reduced the amount of reduced the amount of days on here for the next chart, and it's going to be very huge to get above this significant trend line, because when that's the case, this could be, at least from what I've seen on this chart, it's an indicator that could be saying that the buyers are regaining its level of control. So I'll keep you updated when it actually gets above this high, and that will be on the Silver Log webpage. And I'll just keep it on. I'll just put it on the web page there. So now we're going to take a look at some volatility, and this is what I think would be important to see for the breakout of our range that we're in, because this is the volatility chart, and this isn't the one I wanted to show as of yet. This is the first one I wanted to show. And these blue, green, and red lines represent the 50-week high and low, or the 50-period week high and low. And what this is the percentage gain per day from top to bottom. So if the bottom on silver happens to be 18, and the top happens to be 18.54, that's a 54-cent move, or 3%. So generally speaking, the average volatility lately has been about 2.5% top to bottom, but it's mainly been trading in a lower level. So we need to really see this trend line break for the range to break. That's what I've been thinking anyway, because whether it's a breakout to the upside or a breakdown lower, it's going to need a breakout of this particular range. So therefore, we'll take a look at its second chart. This is logarithmic, same chart. It's like I say, it's pretty much got to break out of this range to the downside. You don't expect it to break it to the downside, but when it does break this range to the upside, that's when I would expect it to be able to go through its next big significant move. Now, we had this breakout of the upside not only for a brief period in here, but it broke it here, and then it continued another downward range. So the same thing could theoretically happen again, where it breaks it to the upside and then it continues another downward range. So we'll just wait and see how that ends up looking anyway. So over the last few days anyway, you got some significant moving averages. They're going lower. So the volatility right now is very low on silver. I did a video a few weeks ago showing its longer term volatility, and it's really, really low. We are nowhere near what the volatility was in the 1970s, and I really do expect to have massive volatility coming our way, where a breakout of this 9% level to be coming very, very soon, whether it be this year or whether it be next year. I'm expecting massive volatility within the silver market. So I'd like to thank you for watching this video and for going to the Silver Log and checking out the page. Have yourself a magnificent weekend, everybody. Bye-bye.